All right. We certainly appreciate everyone taking the time to dial in. Normally, this scheduled presentation was going to be in Greene County today. We were going to be down in Springfield. But,
hey, Jim.
Yes.
I'm sorry to interrupt. You're awful quiet. Is there a way you can turn up your volume a little bit? We can hear you, but just barely.
Is this any better?
Much better. There you go. Thank you.
So we appreciate everyone taking the time to dial in. We were going to be in Springfield today doing this in Greene County. Typically we do 4 or 5 of these a year around the county. We'll do northeast and southeast and southwest and the central portion. But COVID had other plans for us. So we're making do with this, and we sure appreciate everyone dialing in. I think the main thing I want to stress is that even though the pandemic has affected everyone, it hasn't shut down CERF, it has not shut down Empower. We are still here for you. If you have questions, please reach out to us. We're still open for business. So if we were doing this in person in Springfield, I would open with my standard joke when I'm down there, which is that I grew up in Springfield. I went to Parkview and SMSU, so speak slowly to me. I guess I can still do the joke. Also, if we were doing this in person, you'd have to sit through some of my magic and juggling tricks, so we've spared you that at least. Let's go ahead and get started here with slide 1, please. The goal of any plan is to become vested. Well, with CERF, you're vested at 8 years. So what that means is once you work 8 continuous years with the county, you're going to get a pension. How much you get will depend on a formula. And the formula looks at how long did you work and how much did you earn, and it spits out a number. At 62 or older, you'll get that entire number. You could take it earlier. You could take it as early as 55 at a reduced number. In fact, at 55, it's cut in half. So as long as you've got those 8 years and you're at least 55 years old, you could start drawing your pension. I assume everybody on this call is vested or will be very soon, and probably thinking about retiring in the next year or 2. If you're in loggers, which is a separate pension plan, you do contribute less to the CERF pension, therefore you will get less. You'll contribute 2/3 as much, you'll get 2/3 as much. We've actually run the numbers on people, and they still come out ahead in the long run because they have 2 pensions. They have the CERF and the loggers pension. So your CERF pension would be a little less than a non-loggers person, but you'll still come out ahead because you have that extra pension plan. Let's go to the next slide, please. The required minimum distribution actually probably affects you more on the savings side, which Robert's going to talk about later. But all it means on the pension side is if you have retired and you've reached age 72 and you have not started drawing your pension, you do need to start drawing it. Now, Robert's going to talk about on the savings side, if you've retired and you haven't started taking savings, that applies to you there also. Go to the next slide, please. When the time comes for you to retire, we're going to run 3 formulas for everybody. And we're going to pay you whichever formula gets you the most money. These formulas are in a brochure that we have called When You Retire. Your payroll folks may have that. Your county clerk's office may have that. They're available on our website, mocerf.org, if you want to go and download it from there. But if you really want to roll up your sleeves and dive in and understand those 3 formulas, that's a great resource for what those are. But the main thing is we're going to run 3 formulas for everybody. Whichever gets you the most money is the one we're going to use. The formulas look at how long did you work and how much did you earn. So we're going to count creditable years of service up to 29 years, and we're going to look at the 2 highest years of salary and average those together. Now, again, I'm talking about CERF. Loggers has different formulas, and you'd want to talk to them about their formulas. But on the CERF side, two highest years of salary averaged together whenever they occurred, and consecutive years of service up to 29. Used to be 25, and now it's 29. Let's go to the next slide, please.
Hey, Jim.
Yes.
I am sorry to interrupt. I've gotten a couple of messages via chat that people are having a hard time hearing you. Is there a way that you can speak up a little bit or turn up the volume, or maybe, I don't know if you're connected via headphones or something, if you could make an adjustment because they're having a hard time hearing you.
Okay, I'm holding the mic as close to my mouth as I can. Is this any better?
It sounds better to me, but if other folks are having issue, please let me know again. So sorry, Jim, I didn't mean to interrupt.
No, that's fine. Yeah, let Connie know if you're having audio issues here. I will stop from time to time to give Connie a chance to ask questions. I know this entire webinar process can be cumbersome, but we want to make it as easy as we can on everybody.
Okay, so I just got a message back saying that's much better. So okay. Thanks, Jim.
Now, thank you for letting me know. All right. If we were meeting in person, you would have registered for this and we would have a benefit projection waiting for you. So I'm still going to encourage you to try to get a benefit projection. And there are a couple of ways you can do that. We mail annual statements to everybody in April of each year. So if you've still got that, you might dig it out. You can also go to our website, mocerf.org, and find that most recent statement. Or if you want to run a benefit projection for yourself, you can do that also at mocerf.org. If you've never registered on the website, we can help you do that. You will need a member ID number. You can call our office at 877-632-2373, and we will walk you through how to get registered and give you that member ID number. If you're not comfortable.
Hey, Jim.
Yes.
I'm so sorry. We have a question about the CERF website. Will this presentation be posted to the CERF website?
Yes, it will be. We're gonna record this. We're gonna post it on our website. We'll break it into two sections, one for the pension, one for the savings. We did a couple of others earlier this summer that are also available right now on the website. That's a great question. Thank you for asking that.
Thanks, Jim.
So if you're not comfortable running a projection for yourself and you don't want to dig out the most recent statement, you can call our office and we will have a benefit specialist prepare one for you and send it to you. So there's a couple of different ways that you can get that projection because it's a nice thing to know, just to have a general idea in mind. Now, we won't know exact numbers until we get the final payroll from your county and we know you're not going to be receiving any more income. Then we'll have final numbers. But right now we're using our best guess based on the information we have right now. Let's go to the next slide and pause for any more questions. All right. So you start the process by giving us a call 30 to 90 days in advance of your last day of work. We've got some forms you're going to need to complete, and we'd like to give you a little lead time to get those done. Some of those are forms you're going to complete, some your county clerk's office is going to complete, some your bank is going to complete. So there are different steps, and so that's why we like to give you some time to get all that back to us, but you can really help us by getting us that information 30 to 90 days in advance. If you retire, let's say your last day of work is December 31, nothing's going to happen throughout January. We're processing all this paperwork. If we get everything in on time, we should be able to get you your first pension payment on February 1. And that would include a retroactive payment for January and then a payment for the start of February. And from then on, it's always going to be the first day of the new month. Now, it's possible if there's a delay with some of this paperwork, you may have to get 2 months retroactively. We hope not, but again, that's if you can help us and if we get all the forms from your bank and your county clerk's office, we should be able to get things going with only 1 month retroactive payment. You will get paid retroactively for however many months it takes to get your pension started. If you've already retired, give us a call before you want to start drawing that pension. Very similar process. Let's go to the next slide, please. I am going to zip through these quickly. I don't expect you to memorize these, but I'm just giving you an idea of the forms that we require. So these are going to come in a packet we're going to send to you. And again, you initiate that process by calling us 30 to 90 days in advance. But there's a Form 2B that we'll need. Next slide. There's a Form 2B, and that's a designation of survivor form. Now, we're going to talk more about that in a second. You don't have to designate a survivor, but if you choose not to, if we'll go to the next slide, please, you can see where you can decline to designate a survivor. But we're going to talk more about survivors in a second. Let's go to the next slide. All of your pension payments are going to be paid via direct deposit into your bank. So we do have paperwork for your financial institution. And on the next slide, you'll see there's a place for your bank officer to sign. So you want to get that signed and get back to us. Let's jump to the next slide. Your CERF pension payment is a taxable event. You are going to have to take into account federal income tax. So there's a form for W4P, the federal income tax, and that's where you can decide if you want us to withhold a certain amount for federal taxes. You don't have to, but you can, and you can change that amount at any time. I'd encourage you to get with a tax preparer and come up with a plan. As I said, you can adjust that at any time. Robert's going to talk later about the pension, the savings side and the tax implications on that side. But on the pension side, you tell us how much you want withheld, and you can change that at any time. Next, please. So if you're still living in Missouri, we've also got Missouri state taxes to consider. If you move to a state that doesn't have state income tax, you won't have to worry about that. But if in Missouri, we'll have that state income tax to deal with. So again, same thing, you decide how much to withhold, and you can adjust that at any time. Go to the next slide. All right. We talked about this earlier, but if you've got those 8 consecutive years, you are vested. And if you are at least 55 years old, you can start drawing your pension benefit. At 62 or older, you get the full amount. So the formula looks at age or years of service and average of the 2 highest years' salary, and it spits out a number. So at 62 or older, you get that full number. When we say that these amounts prior to 62 are actuarially reduced, what that means is, all things being equal, you should receive the same amount throughout your lifetime, no matter when you begin taking it. There are formulas and there are tables, and they project how long we think you're going to live. And so if you take that money starting at 55, you'd get a smaller amount per month, but for a longer period of time. If you take it at 62 or older, you'd get a larger amount, but for a smaller period of time. And that assumes you live as long as the tables project you're going to live, and you don't get struck by lightning the day after you retire. The formulas will show you the amount for different ages. You'll give us an idea of what age you want to start drawing your pension. The estimates we send you now are our best guess. Once you actually retire, we'll send you the final numbers, and you'll see the hard and fast numbers that you can rely on. Let's pause for questions and go to the next slide.
No questions at this time.
Good deal. All right, I am going to spend some time on this next part because I do want you to really understand this. This is pretty important. When the time comes, we're going to ask you, how do you want to take your pension payments? You don't decide that now, but this is after we've got all the documents back from you, and we know you're not going to get any more payroll from the county. Then we're going to send you that final document. That's where we're going to say, do you want this, this, or this? And you'll select something and you'll send it back to us. So you don't decide this now, but it's a good thing to be thinking about now because it's an important decision. The normal form of payment is called a single life annuity. This is a payment to you and no one else. It gets you the most money per month, but it does stop upon your death. There are no beneficiaries if you choose the single life annuity. However, if you do want to allow for beneficiaries, there are a couple of ways we can do that. Let's go to the next slide. One of them is the joint and survivor option. So here, you get paid a certain amount, and upon your death, your beneficiary receives either 50, 75, or 100% of that amount for the remainder of his or her life. So if you choose the 50%, you'd get a certain amount. Upon your death, your beneficiary would get half of that. Or the 75%, you'd get a certain amount. The beneficiary would receive 75% of that. Or 100%, you'd each get the same amount. You'd get a certain amount, and upon your death, your beneficiary would get that same amount for the rest of his or her life. Now, if you choose this option and you outlive your beneficiary, you don't name a new beneficiary, but your payment would be bumped up to the single life level. So you'd get an increase in your pension payment. If you outlive your beneficiary, you would get kicked up a notch back to the single life annuity amount, and you'd see an increase. So again, that's nothing that you do voluntarily. That's just if you do happen to outlive your beneficiary on the single life joint survivor option. Let's jump to the next slide. This is another way to allow for a beneficiary. This is called the 10-year certain and life. Now this one confuses people, so I'm going to explain it a couple of different ways, and I sure hope it makes sense, and if it doesn't, please let us know. So,
Jim?
Yes.
We do have a question.
Please.
I think it's on the previous slide. And the question is, how is the 50, 75, 100% decided?
Yeah, that goes back to the formula, and the formula looks at your total years of service and your 2 highest years of salary, and it spits out a number. We will show you those options. If you choose each of those, you'll see the 50, 75, or 100%. Right now, anything you get from us is our best guess what those numbers will be, and they'll be pretty close. When you actually retire and we send you the final document, again, that formula will show you the exact numbers. It'll say, do you want the 50, 75, or 100%, and you'll see the actual dollar amounts. You'll make your decision based on that. Really good question.
Thank you.
So the 10-year certain in life can be confusing. The main thing I want to stress here is we're paying you for life. We are not cutting you off after 10 years. We're paying you as long as you live. But if you die during those first 10 years, your beneficiary would get paid for the remainder of those 10 years. So let's say you die 1 year after you retire. Well, your beneficiary is going to get paid for 9 more years. Then those payments would stop. If you live beyond 10 years, and we hope you do, then great, you're getting paid for life. But after 10 years, there's no longer any money left over for a beneficiary. So we're paying you for life, and if you die during the first 10 years, we're paying your beneficiary for the remainder of those 10 years. We're guaranteeing 10 years. If you take the normal payment, the single life annuity, and you die 1 year in after retiring, well, you got 1 year of pension. But if you take the 10-year certain, if you die 1 year in, somebody's going to get paid for 9 more years. Your beneficiary, or if your beneficiary has passed, we pay your estate. We're paying somebody for 10 years. We're guaranteeing that. Some people look at their family history and they say, well, in my family, people tend to not live long after they retire. And they like the idea of locking in 10 years. So this is a nice option, but it can be confusing. We're paying you for life. We're paying somebody for 10 years. If you die during those 10 years, we'll pay your beneficiary or more than one beneficiary for the remainder of those 10 years. Payments would stop. If you live beyond 10 years, we're still paying you for life, but at that point, there's no longer any money left over for a beneficiary. I'll pause here for questions and we can go to the next slide. Let's keep moving.
It doesn't look like any questions at this time.
I've either explained it perfectly or put everyone to sleep. The next option is for people who retire before age 62. So this is only for those folks. It's called the level income option. What we're going to do here is we're going to project what we think your Social Security payments will be, and we're going to front load your CERF pension payment to account for both sources of income prior to age 62. We're paying you more money up front, what you would get from CERF and what we think you would get from Social Security. Now, we don't know exactly what you're going to get because we're not pulling any information from Social Security, but we're looking at your work history with the county, making an educated guess. If you had other work outside of county employment, we would not know about that. But we're using the information we have available to us, making a guess what we think your Social Security payment would be. So if your CERF payment amount is X and your Social Security payment amount is Y, before age 62, we're going to pay you X plus Y. Starting at age 62, which is the earliest you can draw your Social Security retirement, we're only going to pay you the X amount because we assume Social Security is going to start paying you that Y. So there's two sources of income after age 62. Prior to age 62, there's one source of income, and that's CERF, paying you what you'll get from CERF and what we think you'll get from Social Security. Again, it's our best guess. So that means that your income should stay level once you turn 62, which is now there are two sources of income. We get calls all the time from people who turn 62 and they see that CERF pension payment drop and they call us and say, hey, what the heck happened? Well, what happened is you turned 62, the pension portion of the payment dropped off because we assume Social Security is going to start at 62. Robert's going to talk later about Social Security, your full retirement age, and your options regarding Social Security. If you don't plan to start Social Security at age 62, this level income option would not be a good choice for you because your pension's going to drop off at 62. We'll go to the final slide on this section, which is the joint and survivor and level income, which combines joint and survivor annuity and the level income option. It causes the greatest adjustment at age 62 then. I will pause here if anyone wants to ask any questions. Let me just stress that these aren't decisions you make yet, but it's good to be thinking about them because once you make that decision, it is irrevocable. And that's state statute. That's not us being, I don't know, whimsical. This is how the state law is written. Robert's going to talk later about the saving side, and he's going to talk about some IRS regulations. So again, these aren't just rules that we made up capriciously. This is how the laws are written, and we want you to understand.
Jim?
Yes?
We do have a question. What if you are not eligible for Social Security until age 67?
Okay, that's a good question. You're eligible to start taking your Social Security at 62. Now, your full retirement age may very well be 67. And again, Robert's going to hit on that later. And so you've got that decision to make. Do you want to start taking your Social Security earlier at a lesser amount, or do you want to try to hold off and get your full Social Security at your full retirement age? Really good question.
All right, I think that is it for now. Thanks, Jim.
Let's jump ahead. So your monthly CERF payment benefit is a taxable event. None of this money has been taxed yet. It's gone in pre-tax. It will be a taxable event. Federal income taxes and state income taxes if you stay in Missouri. You decide how much you want withheld on the pension side, and you can adjust that at any time. Robert's going to talk more later about the tax implications on the savings side. Now, I am not a tax expert. Do not take tax advice from me. There is such a thing as the Missouri Public Pension Exemption. I just want you to know that it's out there. Talk to your tax preparer or visit the Department of Revenue website to learn more about if you might qualify for the Missouri Public Pension Exemption. I just am not qualified to give you any tax advice about that. Let's pause here. Jump to the next slide. So, a cost of living adjustment in the retirement business is abbreviated, use the acronym COLA. A COLA is a way of trying to keep pace with inflation a little bit. CERF can pay a COLA every year, and it can be up to 1% of what you're drawing. This last year, we paid the full 1%. That's something the board of directors decides, and it takes effect each July 1. So you might see a bump on your pension payments when that COLA kicks in. Social Security offers a COLA, Loggers offers a COLA. We get calls from people in July and they say, hey, my pension payment went up, what happened? And they're not complaining, they're just asking what happened. Well, what happened was that COLA went into effect July 1, be as much as 1%. In the last few years, it has been the full 1%. Let's jump ahead, please. When you receive income from your pension provider, you will get a 1099 form so that you can do your taxes. Like I said, this is taxable income, and we're reporting it to the IRS. The 1099 shows what we reported the IRS. You would get a 1099 on your savings. You would get a 10 loggers also. The law says we have to get that form to you in January. Now, give us a little time to get the documents prepared and sent out. So you'll probably receive it in the mail in early February. It will also be on our website, mocerf.org. It's a great way to access it. I get calls from people on January 2 saying, I'm ready to do my taxes. Where's my 1099? And while I appreciate their gung-ho attitude, it's just not going to be ready that early in the month. So it will be ready later in January and in the mail probably in early February to you. Please keep your mailing address updated with us. We get a lot of 1099 forms returned to us because we have bad addresses. Any questions about the 1099s? All right, let's jump ahead. This question comes up more than I expected, and it surprised me at first. And the question was, after I retire, can I go back to work? And at first, I thought people were asking, can I go back to work in my old job with the county? But many of them were just asking, can I go back to work anywhere else? Will that affect my CERF pension? So let's address that first of all. You can go to work anywhere else. You can start your own business. You can work at Walmart. Nothing like that will affect your CERF pension in any way. You can earn as much as you want. It will not affect your CERF pension. However, if you come back to a CERF county in a CERF position, then you want to keep it below 1,000 hours a year. We consider 1,000 hours a year full-time. So if you work below that, it's part-time. And you can work part-time and draw your pension. But in Missouri, if you work full-time, cannot draw your pension also. It's called double dipping. Some states allow it, Missouri does not. So you want to watch those hours. It's 1,000 hours in the calendar year. Be sure to get with your payroll folks and make sure you don't exceed that. If you do get to 1,000 or above, your pension payment would be suspended until you retire again. And then when you start drawing that pension the second time, it will reflect both those periods of service. So again, part-time below 1,000 hours a year, no effect on your pension at all. 1,000 or above is full-time. Your pension would be suspended till you retire again. Let's pause and take any questions on that.
Questions at this time?
Well, that's very good then. Let's jump ahead. By the way, if anyone has questions later, you can still ask Connie. I'll be around, throughout the webinar all the way to the end. Still glad to take your questions. So far, we've talked about what happens when you retire, but I want to talk about what happens while you're still working, just because this is a good thing to stress to people. While you're actively on the payroll, there's a $10,000 death benefit in effect. We're going to pay your beneficiaries on file $10,000 if you die while actively employed. Please keep those beneficiaries current. I'm begging you. We have had cases where there's a divorce and a remarriage, and the beneficiary never got changed. The employee dies. Ex-spouse gets the money. So if you've had any life-changing events, please update your beneficiaries. If you don't know who your beneficiaries are, we include it on that statement we send every April. It's available on our website. moserf.org, or again, you can call us, 877-632-2373. We will look up your beneficiaries. If you are married and vested, so you've got those 8 years in, you're still employed, and you were to die, there would be the $10,000 death benefit, plus your spouse is entitled to a 50% survivor benefit. It's as if you had elected the 50% joint and survivor option. So your spouse would receive half of what you would have gotten from your pension. Your spouse can take that when you would have turned 62 or sooner at a reduced amount. But that's the 50% survivor benefit if you're married and vested. Now, if you're single and vested, so you've got those 8 years in, but you're not married, if you were to die, it would be the $10,000 death benefit paid to your beneficiary, and your beneficiary would receive a full refund of any contributions you had made to CERF. Just because you've updated your beneficiaries with CERF does not mean that you updated them with CERF savings or loggers or any other benefit providers you have in your county. We don't record keep each other's plans. We record keep our own plans. So if you say, hey, I think I did this form already, well, you probably did it for one but not the other. So you want to make sure you've got all your bases covered there. If you have any questions about death benefits, call our office and speak to Kay. She is great. She will walk you through all of that. So we've talked about some important stuff today, and some of it can be kind of dry information. I hope it made sense, and I certainly appreciate everyone taking the time to listen. The main thing I want you to take away with is call us 30 to 90 days out. We'll get some paperwork started. The formula is going to say, here's what your pension's going to be. The formula looks at years of service and 2 highest years of salary. You will need to get some documents back to us. Then, once you're off the payroll, we'll send you that final document where you actually select what option you want to choose. You cannot change that. And again, that's state law. If you elect something and send it back to us, you cannot change it. We got a call from a gentleman recently who had retired many years previously. He took the joint and survivor option, and he listed his spouse. They've since gotten divorced. He said, can I change that? We had to say no. State law says once you elect something and send it back to us, cannot change it. So that's why we want you to really think about it now, even though you don't decide anything. That concludes my portion of the presentation. I'm going to pause real quickly for questions, and then I think Connie's going to give us a little break.
All right, well, Jim, we do not have any questions in queue at this time. So I have 10:41. So let's go ahead and take a 5-minute break, and let's come back. And I know it's an odd, but 10:46, and we're going to get started promptly at that time. I encourage everybody to come back for the second portion. Robert Eastburn is going to be talking about a little bit more about Social Security, about Medicare, Medicaid, and then also about the 457 and 401A CERF plans. So we will go ahead and take a 5-minute break, and we'll see everybody back at 10:46. Thank you.